This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our trade alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. This is AJ Monty with the Market Guys, and I'd like to welcome everyone to tonight's open house Q&A. Some of you know this is my favorite time of the month where we get together, we analyze stocks and answer questions, but what you may not know is that this is also the favorite week of the year for me, being Thanksgiving holiday week, and it's a time where my wife and I prepare to have the kids, the grandkids, the in-laws, the relatives and cousins, and everyone comes over to our place, and we have about 14 people staying for the long weekend with us, so it's going to be quite interesting. I just hope the weather holds up for us. We're supposed to get a little rain on Thursday. We'll see how that pans out. I only wish it was a little bit of snow. I know we're here in Florida, and that would be nice to get at least one time. And some of you up north are already getting it. Those of you who are listening from Canada are probably getting it as well. And you might get tired of it, but the folks down here in Florida would love to see it at least once in a while, a rare while that would be. Interestingly enough, we had a move in the market today that's already following exactly what my forecast lines were from last week. The weekly market report went out on Friday. Actually, some of you got it on Saturday morning. And to review that, I'm just going to recap the major indices, and then we'll get into your stocks right away. What I did last Friday is I simply extended the forecast line from last week, and I drew this additional line right here, which more or less extended that trend in the upward direction. Now, for those of you who are new to candle charts, look at this candle right here. This is a long rectangle. That's called the body. And notice one thing, there are no shadows below or above that candle. So what that means is that the Russell 2000 opened on the low and closed right on the high. In fact, what I could do is I could go to a minute-by-minute chart so you could see exactly how that happened. Here is the opening right here from Monday. It opened on the low and traded all the way up to the high where it closed exactly on the high. So this whole area right here to the right is what happened today, minute by minute. And again, it opened on the low, closed on the high. So when you have that happen, it tells us that there are motivated buyers coming into the market. Now, please remember that, just again, a recap as to how I draw my trend lines. When I'm making a forecast and you see me draw a diagonal line, whether it's in an upward direction or a downward direction, the end of the line becomes my target for that particular week. So you can see here, even just today, we almost hit my target that was put out last Friday. Tomorrow, I think we're going to a little higher. We'll most likely hit my target for the Russell 2000, and that's how that works. Now, one little bit of information that you definitely want to know about is that we have a shortened trading week in the U.S. markets for the Thanksgiving holiday. So when we don't have a full 5 days of trading. So what happens is a lot of people take vacation, they take time off, they move to neutral positions in the market or get out of positions that might be profitable, and they go on holiday. And what happens is when there is a lack of participation among investors, the volume tends to slow down and the markets get thinned out. So they're easily pushed around by the fund managers who decide not to take a vacation. And I've seen it year after year for many years. I do see the markets being manipulated or pushed in whatever direction those market makers want to go, or fund managers. Let's face it, if there's a thinly traded market and you own the stock, and you're going to get paid your year-end bonus on your profits for that particular position, guess what? You're going to spend whatever buying power you have towards the end of the year, and you're going to rally that stock up. Is it illegal to do that? No, there's nothing against the law that prevents a fund manager or money manager from pushing a market in favor of their position. Now, do I think it's unethical? Yeah, I do. I think if you're hurting the general public because they're taking a vacation to benefit your own pocketbook, yeah, I think that's unethical. But it's not illegal. It's kind of crazy, isn't it? Our laws are not necessarily based on ethical standards and practice. So we have to learn how to be smarter than those who are being taken advantage of. And then as we gain this advantage, we can go and maybe even profit ourselves, knowing what these institutional traders are going to do. Now, if I were to go on Fox Business News or CNN or MSNBC or wherever, I probably would not be invited back upon letting that cat out of the bag, because I would become the enemy of the institutions immediately. And they would get phone calls from the station, don't let that guy back on. So I don't talk about this when I'm on the airwaves. I'll talk about this in private settings to our clients and such to give them the street smarts that they need to maneuver in the market. And I hope this information helps you as well. Now, that's the Russell 2000. Now the S&P, which is the SPY, this is the S&P ETF. What I forecasted last week is, again, this red candle was Friday. I said we would most likely go up this week and eventually test resistance up here. So what I can see happening here is I could see that the market will probably move up this week. And what I'll do is I'll leave this line in place for next week. Now, there's a thing called the Santa Claus rally, whether you believe in Santa Claus or not. This year-end rally, this push to rally on a high, is part of that story that I just described to you with regard to the fund managers pushing their positions up to get the big fat bonuses and the payout at the end of the year. Okay, but then what happens is after December is over, guess what? We have another cycle in the market called the January effect rally. Now, what is that? Can anyone tell me what the January effect rally is? Have you heard of that before? You just type it right in, and I'll see if I could highlight you as being part of the interactive crowd there. Let's see. We have anybody? Okay, Joe Campbell says a drop. Yeah, that's what happens. The January effect rally is actually when the fund managers and the big money folks sell their large cap stocks that they just bid up in the Santa Claus rally. So think about this. They spend whatever dollars they have left in cash available or buying power. They rally the big positions that they have holding. They rally that up towards the end of the year. Then the beginning of January, after they got marked for the payout on the bonus, they sell those positions, which caused the large cap stocks to go down, but they're never out of the market. So what they do is they take the money that they've collected from the sale of the large cap stocks, and then they put them into the small cap stocks. So the January effect rally actually is the rally that affects the small cap stocks. So come January, guess what? For the option traders and the equity traders, I'm going to be looking and shopping for the small cap stocks that are poised to rally. So I think we have a really good thing going here, as long as you know the cycles and know how to participate in the cycles. You know, it's almost a joke, really, because one of the big cycles, and I make fun of it, but I'm also very serious about it, is Hershey, ticker symbol HSY. If you look at that stock, it's the chocolate company in Pennsylvania, in Hershey, Pennsylvania. What they do is people tend to buy Hershey in December. There's lots of chocolate for the holiday season is going around. And the stock tends to rally from the end of December all the way up to February, which is Valentine's Day, February 14th, and then people start to sell it. Now, you'll have to look. Watch. Let me see if I can find the chart of Hershey, HSY. I'll show you this. Now, look, here is December right here. See, back here of last year. Look, right at the end of December, the rally took place right up into February. Look at February here. And then people started to sell it into the Valentine's Day cycle. Now, yeah, you could see it went higher after that, but I'm pointing your attention to this move right here. Let me see if I can zoom in for you. I'm pointing your attention to the move that people play the most. End of December, right up into February, and they sell it. So this is the leg that and year after year you'll see this happen. So chances are, it wouldn't surprise me at all if our subscribers get an alert from me where we have the Hershey play again, because it's something that we've been doing year after year after year. If you've been a subscriber for a number of years, you know I always do the Hershey play, and we have never lost money on that play. Never. There hasn't been a single time where we lost money on the Hershey play. Why? Because it's a cycle, and it becomes the game almost for the other investors who know this happens. So what happens, you could even call it self-fulfilling prophecy, where people know they're going to get in. Some people try to jump the gun and get in the beginning of December, and some people try to get out a little bit before the 14th of February, and that's okay. But the whole play here is trading that leg. Okay, so remember these cycles when it comes time to take in profits and take new positions. Okay, now let's look at the Qs. See here, my forecast line for the Qs was still an extended rally. I'm not expecting a massive rally here in the Qs. You can see these are my forecast lines from previous weeks. And you can see that I think we're going to see just a little bit of a rally on the Qs. But the Qs come January, in the January effect rally, that's when the bigger up moves will take place, because the NASDAQ market tends to trade the smaller cap and the mid cap stocks, and the large cap stocks tend to trade on the New York Stock Exchange. So hopefully that's a little bit of a lesson for you, knowing where to shop. Okay, so if you have any questions on this, type those in, and I'll be taking questions. Remember, when we're done with the market analysis. Okay, now let's look at the VIX. Okay, because the VIX is the leading indicator, and last Monday, again, this is what I said. Last Monday, I said the VIX would most likely drop. Now remember, this big red candle was not on the chart last week when I did that report. You can see already the VIX has already hit my target down here, the pivot point. Actually, what I think could happen is the VIX could drop a little bit more before it starts rallying next week. And I'll probably leave this line in on Friday as we track the VIX over the next week or two, maybe week and a half. Now look what's happening with the VIX. See this blue line right here? That's the 20-period moving average. And you can see now the 20-period moving average is starting to turn up. So this moving average is going to, for the most part, act as like a role reversal support level. So when this VIX starts going higher, that's a contrarian indicator to the S&P. Okay, so when the VIX starts to increase in price, that becomes very bearish for the S&P. So that could, again, be something that we have to keep a close eye on as we move into 2018. We really have not seen any kind of market correction whatsoever. And we're still in this, what I call the Trump rally, because the market's still reaching for record highs. It's not storming up. It's just kind of creeping up. And you can see here, even if I go back to the diamonds on the weekly chart, I can even go to the monthly chart, you can see this is still a major bull market since the end of 2008. And we have not seen any kind of a major correction. Back here in 2015 to 2016, we had just a little bit of a pullback, but I wouldn't call that a market correction of any sort. This has gone even more vertical in the past months than it has in a very long time. And the angle at which the market is increasing, remember, this is a monthly chart. You can see right here, this is a monthly chart. And this, if I were to draw fan lines on this, I don't want to draw too many lines, but if I draw a fan line from this low to this low, you can see that the angle of the average upward bull market here was pretty steady. But then if I were to connect this low to this low and higher, you can see that the angle at which the market is rallying month after month is increasing. And this cannot be sustained indefinitely. You have to have a correction for the market to be healthy. So what's happening is there's a lot of analysts out there right now. They're saying, you know what? We're seeing the breadth of the market is starting to shift. We're getting bearish. We're even getting concerned to the point where we don't want to put any of our investors in this market right now. So a lot of the advisors out there are actually holding back their investors from getting in because the advisors themselves believe this is a market top. And that is actually being displayed in the volume. Look down here. You can see the volume month after month has been decreasing as the price of the market has been going up. That's a negative divergence. That's a price volume divergence that tells us that as the volume is dropping, the buyers are drying up. And that's what the money managers and the advisors for private clients are telling their clients. They're telling them, watch out. We're not going to get you fully invested into this market because we believe there's a market top. They're basically taking responsibility for their clients' money and protecting them at that particular point. So that is the general analysis of the major indices, and I just wanted to go over that with you so you could see where we stand. And if any of you have a comment, if you want to ask a question, we can try raising your hand if you have a question, and I'll unmute you. Or if you have a stock symbol you want me to analyze, now would be the time to start putting that in. So, all right. So Sean is looking at ABX. All right. So if you have a position you want me to look at, let me know what your position is. If you're looking or if you're holding it already, let me know. Okay. So Sean says ABX. That's Barrick Gold. Okay. So let's take a look at ABX. And Sean says I'm long. I have an entry of 1395. With a stop of 1383 and a target of 14.5. All right, now let's look at this. Sean, first of all, these were my forecast lines for ABX. You see, I said we would probably pull back a little bit before bouncing. And this line, I don't recall if these were the lines from last month's open house. I don't think so. I think it might be from one of the reports I put out. But anyway, this line down here is a major support level for ABX. Now look at what's happening here. Today we had a red candle as the stock is kind of going down, but notice there's a drop in volume here. So if you have a red candle as the stock is going down on lower volume, it tells us that the sellers are weakening, which in turn is bullish for your position. Now, you have an entry of 1395, so it's trading right around where you are. What I would say, though, is that you have a stop at 1383. So what you have here is a stop that may not be set up correctly because you want to put a stop below support, not on support, because when you have a stock that's at support, we're expecting the stock to bounce off of support. And so if you have your stop right above support and the stock goes there and then bounces, you're going to get triggered. So you're going to get sold out because your stop is on support. And then the stock could most likely rally. And then you're saying, oh, geez, I wish I never put the stop in. So there's a couple of things you can do. You can either lower your stop. And if you feel that that would be too much risk for your position, then I would say lighten up on some of the positions so that you could lessen the shares and lower the stop. That way you're not increasing your risk at any point. So hopefully that'll help you out. Now I'm still very bullish on the metals, whether it be gold, silver, copper, platinum, I'm still very bullish. I think that long term, I really, and I'm speaking personally, I hold a lot of it. I am a buyer of physical gold and silver. I buy coins and bars and such. I accumulate it. I have been. I believe that silver, especially, is one of the best investments. And I think silver could easily reach $100 to $200. I know it sounds almost outrageous, but I think it can get to that point eventually. I'm not saying right away, but listen, if you're young enough and you're planning your retirement, or if you have retirement dollars that you're looking to put it into something, I feel very good about the precious metals. And Barrick Gold is a mining company that's widely held among the active money managers and institutional traders. Okay, now Charles is looking at GE. Now GE is almost like a mutual fund. And it's very interesting here, Charles, because GE has not been trading along with the Dow. It's actually been going opposite to the Dow. Isn't that interesting? The Dow is reaching for record highs, and unfortunately GE is setting 3-year lows. You see here, in fact, oh, that looks pretty bad. Hold on, let me see the monthly chart on that. Yeah, now this is a 20-year low for GE. I don't think it's gonna get to $5. But look at this. Let me just show you something now. This is very, very important, Charles. We have 1, 2, 3, 4, 5, 6, 7, 8, 9 red candles in a row. That is not, this is the monthly chart now. So that's 9 months of selling in a row. Now look at the volume over that 9 months has been increasing. Now here we are. We're in November right now. Okay, we're a little bit more than halfway through November. We're 3/4 of the way through. If the volume surpasses last month's volume, so in other words, if we see a longer volume bar at the end of this month, you want to hold back from buying. However, if you see that this volume bar of the next 10 days stays lower than the previous volume, that actually is bullish. Okay, remember, if you don't know how volume reacts or interacts with price, understand that price tells us which direction the market's going and who's controlling that market, but the volume tells us the motivation level. So if the price has been dropping quite dramatically here and the volume drops, it tells us that the sellers are pretty much exhausted, or at least exhausting themselves. So I think that right now it's not the time to buy just yet, but I think it's a good one to keep on your watch list, and then you want to watch for that volume on at the end of the month. Now, if you do get into GE, understand that this 20-period moving average here is still signaling a downward trend. So if you get into GE and you buy it, let's say around 18, I wouldn't expect it to just go right back into an upward trend right from the bottom here. It might go from 18 up to 19, maybe 20, hit that 20-period moving average and come right back. So you could expect, if you want to play it for a short-term trade, get in, but I would only expect maybe a 10% return on that trade, because that 20-period moving average is going to act as a resistance point. Okay, so keep that in mind. Okay, I'm looking for hands. Does anyone want to ask a live question? We could try that out. Let's see, we have any hands that are going up? We have a lot of people on this call, so let me scroll through. No, oh, let's see, Joe. Okay, Joe, I'm going to unmute you, and let's see, unmute Joe.
Can you hear me?
There you go. Can you hear me, Joe?
Yeah, fine.
Oh, great. Okay. So, do you have a question, or do you want?
Question.
Yeah, go ahead.
How does the diamonds continue to go up with GE diving like it is?
Okay. Well, that's a good question, because the GE, like I said, is basically a company that buys other companies. So it's treated more like a mutual fund. But the Dow stocks aren't it's not a large number of stocks that are in the Dow. So in other words, it's not a broad-based index. The Dow only tracks 30 Dow industrial stocks, or the Dow stocks have evolved over time. They keep adding and replacing stocks to the Dow component, but the Dow stocks still are an indication of the companies that drive the U.S. economy. GE may be even a Dow stock, but it's not a weighted part of the Dow Industrial Average. So if you look at the diamonds here, you can see that's been a significant upward trend, and it's going opposite. And so you have to look at what's going on with the news. Look what's happening right here. One of the headlines is how to avoid the next GE and find, let me see, what did that say? And find industrial winners of the future. See, that headline kind of matches what I just said. GE is not considered an industrial stock like the Dow Jones Industrial Average is comprised of. Does that make sense?
Yeah, thanks, AJ.
Okay. Hey, Joe, how's the recovery in Texas go from the hurricane? Everything back to normal yet, or are they still drying up?
On a daily basis, everything is back to normal. But you never know, actually, that we even had a hurricane hit us like the way it did in Houston. But the physical damage is going to take years to repair because it's such a massive thing. It's in the billions of dollars have been lost. And the thousands of houses are going to have to be torn down because of the amount of time that the water was in the houses and destroyed everything.
Well, God bless Texas. I'll tell you, Texans down there really know how to stick together and survive. That's for sure.
How's Florida doing?
Oh, the Keys are still rebuilding. And I still think Home Depot is going to do pretty well with all the lumber that's going South Florida. So we'll even I'm sure someone's going to mention Home Depot before this call's over for sure. But thanks for joining us tonight. I appreciate it.
Thank you, AJ.
Okay. All right. I'm going to put Joe back on mute. And do we have anyone else that has their hand up? I can pick them before we go to the next stock. And Joe, you can lower your hand there. You left that one up. Okay. All right. So let's go back to our stock symbols to see who else wants me to look at. Okay. Now, Ann is asking me, is that PayPal, Ann? PYPL. Let's see. PYPL. Let me get that one in there. PYPL. Okay. I just got fat fingers there. And PYPL. There we go. Yeah, it is PayPal Holdings. Okay. Now, Ann says she's holding it, bought it at $68.40. Well, that's great, Ann, because $68.40 wasn't that long ago, but you can see that when it was here, look at what we see down here. There's a gap down here from roughly, it's a $2.50 gap roughly. So you have to watch that one because gaps tend to act as price magnets. Now, not all gaps fill, but 80% of them do. All right, you can see there's even a gap. Oh, there's one all the way down here around 45. Do I think that could fill? I think the one at 45 actually could fill one day. Again, key phrase there, one day. But this one becomes your biggest threat because you have a gap here and you have another gap. Last week it gapped up. So if you bought it at $68.40, what I would say, I don't know, you didn't highlight where you have your stop, but what I would do, Ann, is I would put a stop right below the gap fill point, because the gap fill point, by the time this gap fills, this moving average will already start to move up. So between the gap fill point and the moving average itself, that's going to become a very key support level for you. So if it breaks down below the moving average, it's going to start rolling over and going. You can see the stock has not closed down below the moving average since April, and it flirted with it in July, but it really did not break down below that moving average in any significant way since since back here, even last February. So this one is in good shape. I don't see it going vertical, but you need to protect yourself along the way by putting your stop. I would put a stop at like 72.5 to 73, and then as it goes higher, continue to protect your profits. Okay, that's the best thing to do, is just let the stock tell you when to get out. Don't just sell it. Put a stop in it, and as the stock goes up, that's called trailing the stop. As the stock continues to go up, you ratchet the stop up along that moving average. And in fact, you could just keep it even below that moving average for as long as the moving average is going up. And then when the stock decides to break down, you're out and you've taken your profit. So hopefully that helped you out, Ann. Hope it did. Okay, now Simon says, thinking about SPY, a long put. Okay, now for those of you who are not option traders, buying a put is a bearish strategy. All right, now the September, looking at buying the September 235 puts, September 21st, 2018. All right, now let's think about this in the same way that I mentioned to Ann. All right, Simon. So you could see that the spiders is still moving over that 20-period moving average, but I would not, I'll repeat, I would not take a long put position or short the market until this moving average is showing a breakout to the downside. So you're going to have to wait for the spiders to start going below that moving average. And then the second thing you want to look for is you want to watch for an increase in volume as the stock is breaking down below the 20-period moving average. The increase in volume as the stock is going down will be the signal that tells us that the sellers are becoming more motivated. Very, very important. Now, part two of this is I noticed that you're looking to buy out of the money puts, which are way down here, 235. I think that's too far out of the money, actually. I would rather see you buy less puts, but go closer to at the money or maybe even in the money, because if you buy an out of the money put, even though it's farther out in time, that out of the money put is still going to experience time erosion. So that time erosion becomes your enemy if the spiders doesn't go down and in fact just goes sideways. That you could still lose money if the market just goes sideways. So I would rethink that one and wait, of course, wait for the sell signal and then maybe go a little bit more in the money with that one. Okay, Mike is looking at Facebook. Mike, if you could please tell me what's your position? You just have a stock symbol there, but are you looking to take a position? All right, you're holding it. Okay, there it is. I see the second note. You're looking for an exit. Okay, now where did you get in, Mike? It's trading at 178.74. Let me see if you got that in. Oh, you bought it at 182? You bought it at 182, so you bought it back here. All right. Now, right now, you're still okay. In fact, for those subscribers who bought into, we took a Twitter position, TWTR. I'll go back to Facebook in a second after I look at Twitter. One of the recommendations last week for our equity trades was to buy Twitter, and we did. And look what happened, because there's like an elongated cup and handle pattern forming. And so we're almost at a target price for Twitter. But in the alert, when I showed everyone the signal on Twitter, I did mention Facebook, in that I think Twitter is a better trade than Facebook for a couple of reasons. Number one, Twitter is a lot cheaper, but Twitter has really figured out how to monetize the model. Where Facebook, they really kind of cut their own revenue by restricting people in the number of friends they can have. I don't know if you know the ins and outs of Facebook, social media, Twitter, Snapchat, and all that. But let me give you something on why I try to stay away from Facebook. If you're on Facebook advertising, then you want to get the most of your money. I know this sounds more like a fundamental story, but it is a big difference between Facebook and Twitter. If you're on Facebook and you're trying to get the most out of your advertising dollars, you want to reach the most people. Well, guess what? I'm going to show you an actual. This is my actual on Facebook. I keep that more personal, but on Facebook, I have about 5,000 followers. Okay, let me show you the difference between Facebook and my Twitter page. Now, I tend to be more political on Twitter, so forgive some of the tweets here. But I want to show you something that I don't show often, and this will help you all as investors. Okay, I'm going to go to the analytics here. Okay, and I'm going to go right here. Now, this is an actual report from my Twitter page. Okay, look at the numbers compared to Facebook. Now, I have on Twitter, I have many followers, but look at this. I had over 3 million impressions in 28 days right here on Twitter. In 28 days, I was able to reach over 3 million people. Where on Facebook, maybe I got to a couple of hundred people. Now look at the difference. Facebook is trading over $100 a share. Twitter is below 20. You see? So what I say to you is that if you own the stock, you have to be very careful, because the average investor is not going to be going for Facebook. The institutional investor will be going for Facebook. So you have to do, and I know this is a long answer to a short question, but you have to keep an eye, Mike, on the institutions and what they do. Go to a fundamental report. You can go to Google Finance. You can go to Yahoo Finance. Look at the institutional holders of the stock and watch what they do month after month. And if they start to sell, which it has to be disclosed, if they start selling, you'll see the difference in their holdings, whether or not they bought or sold it. Okay? Keep that in mind. But I would definitely say you got to have a stop below 175 on that, because that's a key role reversal area right there. You see that? What was once resistance back here and here, the resistance is broken. Now resistance is going to turn to support. So that 175 area below that would be your get out point. Until then, I would be more quick to take a profit if it starts going in the money for you on that particular trade. Okay, so hopefully that helped you out. All right, now let's see. HPQ from Ron. Would this be a good entry point? Now remember, HPQ, Ron, remember what I said about the what I said about the Santa Claus rally. I would expect this one to rally right up into the end of the year, but you have to be very, very careful, because in January, this is one of the ones that's going to get hit. Okay, right here, if you're thinking about getting in, you got to be really careful. Right now, the volume is going up on this one. Chances are it will most likely break out here. All right, so I wouldn't be opposed to you taking a position even the way it is right now, because the volume is going up on the green candles. That tells us that the buyers are becoming motivated. The other side of the coin is you have 5 green candles in a row. I mean, actually, I hate to do this to you, but the bullish engulfing pattern back here would have been the ideal position, obviously. The hindsight's 2020, but bullish engulfing patterns work really, really well, and you had one back here. But now what's happening is you have 5 days of green candles. If this one has a lower volume day tomorrow, it's probably going to pull right back on a lower volume day. So if it increases volume, if towards the end of tomorrow it looks like the volume is still going up, chances are it'll start breaking out over this $22 level right there, and then you can get in for a good trade. But believe me, these are not stocks to be holding, because remember what I said before, the general markets and the professionals and the money managers within this market are seeing a market top. They're definitely seeing a market top. And you have to be really careful with that, because if you're taking a new position at the end of the year, boom, you can be left holding the bag right there at the top. Okay, I'm looking to see if anyone has any more hands going up. If you'd like to raise your hand and ask a question, or just continue typing in, either way, I'm going to go right to the list right here. Okay, so let's go. Next is Roberta, thinking of taking a position in BAC, that's Bank of America Corp. All right. Now, that looks pretty good, actually, Roberta, because we have a bullish engulfing pattern right here. and the gap has filled here. And we haven't gotten a complete bounce off of this gap fill point. So what I would think is that if tomorrow you get a green candle, you can't do it now, obviously the market's closed, and I would not do it with this doji right here, because dojis tend to signal signs of indecision. So you can't do anything on a neutral or a confusion sign there. If you see a green candle tomorrow, you have to understand that the 20-period moving average is going to be a resistance point for you. So if you see a good green candle and starts breaking back over the 20-period moving average, that would be a buy, a get in and protect. But if it does not get over that 20-period moving average, guess what? That moving average is probably going to start going down. And this is one of those stocks that trades on the Dow, and that could wind up getting hurt towards January. So be really, really careful of that one. All right. Now, again, just a quick break to let everyone know what's going on here. The members of our services get this session. It's recorded, and it's posted to the member page. So if you like, I would love for all of you who are members to take some time next month, not this month, take some time next month and review this video so you can see how these forecasts and how these signals panned out. I love that. That's the evidence that you have of how accurate technical analysis is. And I do this each and every week, and the percentage of accuracy is uncanny, actually. But it's really interesting to see how it plays out for individual stocks and not just the market index. So, again, do your homework and practice and look at these signals. Okay, so David is thinking about selling a put in AXP. Is that American Express? Let me see. I can't remember that one. Yeah, it is. Okay. Selling a put is actually a long position. Now, I like your idea, David, of a put spread because it limits your risk and it limits your margin. I would be okay actually doing that right now or tomorrow perhaps, because you got the stock bouncing off of a roll reversal support level. Okay, that roll reversal support level is something that is it really stands out with this stock. You see back here was resistance, it broke out, and then resistance turned to support. You see that? Back here, resistance, it broke out, and then it broke out, pulled back just a little bit, and then turned into support. This stock has a history of doing that. So when you see that pattern and you see the stock is in an upward trend, this is a good cash secured put position or a credit put spread position. It's bullish. But just remember, if you're doing you're selling the 92.5 strike, you cannot really hold on to that if it starts breaking down below that support level, because then you're going to be long the stock at 92. And I don't know if you're going to buy any protection into that, but if you just sell the put and you sell a 92.5 put, you're going to be long the stock at 92. And then what happens if it drops to 84? So you have to be very, very mindful of that downside risk and make sure you're protecting yourself. So I like your idea. Definitely like the idea. I would go with it. The technical signals are backing up your idea, but I wouldn't sell a long-term put. I would maybe sell a December put and leave it at that, because remember, in December, this is one of the stocks that's going to start getting sold in January. So December might be your last option play for that particular stock. Okay, let's see. We looked at HPQ, and let's see, spiders, long put. We talked about that. Okay, let's look at another one. Timothy, oh, wait, David says CMCSA. All right, let's look at that one. Now, David, are you thinking about buying this one? If you could let me know, just give me an indication. Because right now, you see the candles are pretty red. The downtrend is still in force. The stock is down below the 20-period moving average. I just don't see the trade in this one yet. And there's probably going to be some better put spread, a short put spread or a long put spread. I'm getting the clues here little by little. Okay. Well, the only thing I would do with this one, you got to back up a little bit, David, and look at the weekly chart because it's going to be slightly different. Right here is a role reversal support level for Comcast. Okay. Now, what you have to watch out for is Comcast is a big communications company, but this company, cable television, what are some of the other big ones? Even CBS. CBS is shifting because so many people are tired of paying the cable bill that they're shifting to streaming media. And so you got to really watch that news with Comcast because, let me see, there's some news out here that came out today. World Games. Okay, I'm not going to get into the news, but you really got to watch that downside. This support right around 34.5 is what you have to watch out for. So if you're thinking about taking a long position, you're going to have to sell put spreads down below that support. I don't feel comfortable because I don't see any pivot points on this one yet. So just be really, really careful and watch that downside. And just don't trade a whole lot of them. That's all. That's what you have to watch out for. All right, I'm going to hop to Michelle. Michelle is looking at buying a leap on AAL, and that's American Airlines. Now, Michelle, interestingly enough, you have a stock here that is showing a bullish engulfing pattern. I like that a lot. So you're not going to have a whole lot of time to get in on this one. So in other words, if you're going to do this one, you're going to have to do it on the opening tomorrow, as long as there's a green candle. Because a couple of things I'm seeing, not only am I seeing that bullish engulfing pattern, but look, you have a slight increase in volume there on that bullish engulfing pattern. And number three, you see that the stock closed above that 20-period moving average today. So I think that American Airlines could actually go up to test these areas of resistance up here around 52. So I like your idea. That's number one. Number two, guess what? Thanksgiving week is the most traveled week out of the whole year. So you're going to have to watch those indicators and really stay glued to the news, because the profits for next quarter are going to rely on how many people are actually traveling this weekend. And there's so many variables out there, Michelle. You got the threat of terrorism. I mean, that really makes people think, do I want to fly? Do I want to drive? Do I want to take the train? Why? Do I want to go private? There's so many different variables. So that's going to really play into this year's season, number one. Number two, American Airlines is going to be inversely related to the oil markets. So you have to watch out for the oil stocks, because if oil stocks, and let's say OIH, for instance, I think that's a good one to track. If OIH starts to go down, then American Airlines is going to start to go up, because as oil prices go down, that means more profits for the airlines. So you can look at American Airlines. You can look at LUV. That's Southwest. All right, Southwest looks pretty bullish there because you got some long candles, long shadows under that candle, and a little bit more expensive. But I like your idea. I like the leaps. I don't know which ones you're going to get into, but let me know what the outcome is, and hopefully you'll make some money before next open house session. Okay, I got to speed it up a little bit. I'm looking at the clock. All right, I'm scanning for hands that might be up. No hands. Yeah, it's like a radio show, folks. You can call in. Really, I used to do live radio. That was very, very interesting because you don't know what the callers are going to say. But yeah, we treat this like a radio show. All right, now let's see. Ken is looking at USO. Here's an oil stock for you, right? USO, I think it is an oil stock. Yeah, USO. Okay, type that one in there, USO, boom, boom, boom. Yeah, United States Oil Fund. Now, the oil fund here, Ken, you're long at 11, so you're barely in the money. You really got a good signal today. There's actually two signals that really came out. On Friday, the stock gapped up, right? When you're trying to take a long position, you don't like when it gaps up. But good thing for you, today the gap was filled. Now, 80% chance after a gap fills, there's an 8% chance that the stock, after it fills the gap, will rally. Okay, so there's a good chance it's going to rally. That's signal number one. Signal number two, it's bouncing off of the 20-period moving average. That's positive. Signal number three, you have a long shadow under the candle. That tells us that the buyers push back the price during the end of the day. If I look at the minute-by-minute chart, you'll see exactly what I'm talking about here. At the beginning of the day, right, the market sold off right up until around 11 o'clock, and then the buyers came in for the rest of the day to rally the stock up. You see, so that is very bullish there. All right, so if you're already long it, what I would do is I would put my stop below the 20-period moving average. So I'll put it like around 1070, and I think you could very well hit your target at 12, because that's the resistance point from back here, back in January of last year, or this year, I should say. So I think you got a good shot at that hitting the target. But listen, if it goes up to 1180, 1190 and hasn't hit 12 yet, don't try to squeeze out the extra 10 or 20 cents, because you determine to hit your target. If any signals come in here, even if it hits resistance here 1160 and starts turning back, I would be very, very quick to take a profit on that, and then bank the profits and leave it for the next trade. So be really, really careful with that one. Okay, let's see. Scanning for hands once again. Boy, you got a lot of shy folks out there tonight. Either that or you're watching a movie while you're watching this. You don't want me to hear the background noise. Okay, I get it. All right, so let's see. That's THX. That's thank you, David. That's thanks. I thought that was a stock symbol, THX. Okay, let's see. All right, so let's look for another stock symbol. DHI. Tim, did we get DHI for you? Let's see. I don't know if we did. Am I losing my memory? Did we go to DSI? No, we didn't. Okay, DR Horton. Now, this is a textbook signal right here that you have to watch out for. Look, here's a textbook bullish engulfing pattern. Textbook. But right after the bullish engulfing pattern, what happened? You have a doji right there. And there's a battle that went on with red volume. The sellers actually won out today. And so this is a very confusing mix signal, because you have a bullish engulfing pattern from Friday, doji today in a shortened trading week. But this is what has me most concerned, is the price divergence from that moving average. This is called the rubber band effect. I tell you, when you're buying a stock, you want it to be bouncing off of that moving average. You don't want to be so far stretched away from it. I think that DH Horton could actually pull back before going higher. So if you're thinking about buying this one, I would wait for the pullback and then try to find some level of support for it to bounce off of, because if you have a stock that's bouncing off support, the support is going to give you a good exit strategy with regard to risk management. Okay, and if you put your stop below the support level, then you're going to be better off. Right now, if you buy it at 48, you're going to have to put a $3, maybe a $4 stop loss below that, and that's too far for me to even feel comfortable with a long position right there. Okay, let's see. There was one other one. Hold on. HPQ, exit. Okay, we got that. There was someone at the very beginning. I think I missed. Hold on. ETM. No, that's okay. Hold on. One more. GE. Okay, we got that. All right. Now let me just review what we did today for the Equity Oracle subscribers. I put out a buy recommendation on this one today, early in the day. Now, I'm going to close with this one, and this is going to help our members who traded it and maybe the ones who missed it today, okay? This right here is a classic, that's a classic cup and handle pattern. Let me define this for you. It's when you see this more or less like a rounding bottom here, and then the stock hits resistance and pulls back. And so this becomes the cup. And then right back here, I don't want to do too many lines, but you had a roll reversal right here. You see that? Resistance here. And this part formed the handle. Now, last week, we took a long position in Twitter, and it worked out really well because we saw the same exact pattern, exactly the same. It's almost a mirror image of what we had last week, and we're treating it the same exact way. The only difference here is if I zoom in, the reason I put this out early on is because we have a shortened trading week. Option Oracle subscribers, I'll probably put a trade out tomorrow or Wednesday morning the latest. So be ready for that one. But what happened is CBS and Intercom Communications, Intercom, they merged today, recently. And so what was happening is the CEO of these companies rang the closing bell, and I knew that was going to happen. So the stock had already been up a little bit, so we bought it right around here. And I was anticipating that the added coverage on CNBC would give people a chance to buy in on the close, and that's exactly what happened. We formed the bullish engulfing pattern. I would have loved to have seen this bullish engulfing pattern on much higher volume, but I'm happy that it's a bullish engulfing pattern. So as it's ramping up, I think it's going to make a move to break out over the brim of the cup. And I think we have a little bit of a rally to go. Now, if you put your stop $2 below the entry point like I recommended, if it breaks out like we think it will, if it breaks out over that high, you're going to have to move your stop up and lock in the profit. So again, if it breaks out like we expect it to, as soon as it breaks out, raise your stop to just below this brim. So raise it to around 12, 12.10, and then just sit with it and keep raising the stop, like I even talked to Michelle about raising the stop on her trade. Okay, so that's the strategy, is to ratchet or trail your stop up when the stock starts moving in your favor. So this one looks really good. I'm very happy the way it played out, and I hope all of you are happy as well. Now, I will not be speaking with you on Thanksgiving, so I'd like to do is wish you and your families a very, very happy Thanksgiving. We have a lot to be thankful for. We really do, and I hope you spread that good cheer around and that optimism. And I look at the glass being more half full than empty for sure. And I think we had a really good year this year, and 2018 is looking even brighter. So I'm looking forward to that as well. Thank you all for joining once again. Have a good night. We'll talk to you soon. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.